Chandraprakash Padiyar is joining us now, fund manager. Chandraprakash, talk to us about how are you analyzing the quality of earnings so far. Some tend to be saying that the kind of weakness in earnings could actually lead to overall big cut in Nifty EPS going forward. Others are saying the earnings are resilient. Which side of the argument are you on?
Well, good afternoon, Ajay, and thank you to having me on the show. Well, to answer your question, if you look at the Q4 FY23 numbers that are being reported right now, let's say around 40% of Nifty companies have already reported or by numbers. And the interesting point to note is that till date, average profit growth for Nifty for the businesses that have reported till now is something like 20%. So I actually belong to that camp which says that businesses in India continue to do well. There are some pockets of businesses which have slightly lower growth or profit margin impact, but largely, when you talk about large caps, it's mainly banks. A large part of large caps is banks, and banks continue to do extremely well. There is auto, which is doing very well, telecom. So there are quite a few sectors, capital goods, industrials. So there is a segment of market which is reporting good numbers. And I believe, or we believe at Tata Mutual Fund that numbers are likely to continue to be on a stronger side. So we are optimistic.
Okay, so that is one part. Let's also talk about some of the specific commentary from companies. But I'm only taking the name of these companies for reference sake. Hero Moto, for example, is talking about a host of new launches on the premium side, gaining market share, etc. Two-wheelers as a part of overall auto pack has been laggard. Passenger cars started doing well, CVs followed on, but two-wheelers till now was hurting because of the K-shaped recovery. Do you think that can reverse in the next coming months?
So on two-wheelers specifically, what you would notice is that volume growth has been a challenge for some years now. However, most of these companies are reporting very strong profit margins. So they've passed on cost increases. In fact, now that commodity prices are correcting, profitability is better. So you have to be selective in what you own. For example, there are two-wheeler company that I know of, which are or stock prices that at 52-week highs, in spite of volume not doing well, because their margins are better and they are reporting better profitability, or profit growth is continuing to be on the stronger side. So if you choose the right business, actually every segment of the market, there is opportunity to make better performance or better returns. But you make a right point. Two-wheeler specifically, there are still some challenges to grow on volumes. So for that reason, within our portfolios, two-wheeler doesn't form a very large part, or actually the portfolios that we manage, two-wheelers is extremely low in terms of exposures.
Again, I want to understand your view on some of the large, very large financial private sector banks and even private sector, very large mortgage company, the leaders. The news may have come now that perhaps the FII flow may be lower than what the street was estimating. I'm not even talking to you about it. I want to understand how are the fundamentals of large mortgage companies in India and very large retail-oriented private sector banks looking, irrespective of the news flow. So not a reaction on that, but fundamentals of these two spaces, looking at the state of the economy we are in.
Well, when you talk about large mortgage-focused institutions, there are very limited number of names available for you to choose from. I would rather, so our focus is more on financial institutions and in that category, more banks. So we have larger exposures to banks, and that too in private banks. Because we believe, so there are 2-3 things that we think make sense from a private bank's perspective. One is valuations, obviously. They do continue to trade at lower than average valuations. When I say average, last 10 years, 15 years averages. So there is room for valuations upside. Two, on fundamental aspect, credit growth continues to be at 15 to 20% for most private banks. There is profit margins, net interest margins are stable incrementally, likely to be stable incrementally. and credit cost. So when you look at 0 DPD, 30 DPD, which is the borrower default ratios that we look at, they are at an all-time lows or closer to all-time lows for most banks actually. And return on equity for most banks are likely to be anywhere between 15 to 18% over the next 12 months. So keeping that in mind, our view is that it makes sense to look at banks and especially private banks, and within PSU, maybe we have one or two exposures in some PSU banks as well. So generally speaking, we think banks are a better bet to play in the financial space rather than looking only at one segment of the financial space, which is mortgage only.
How are you looking at industrials and cable companies, industrial cable, and even retail kind of cable companies, or mid-cap industrials? Because though the ABB, Siemens, and Cummins variety came out with good numbers, good commentary, but valuations over there, according to some, are slightly on the higher side. But there are other in wider, broader market where growth, earnings, and valuations all are falling in place. How are you playing this space, the capex beneficiaries?
So I think it's quite interesting to see that most of these capex plays or manufacturing product capital goods manufacturing companies, their visibility of growth is extremely high. We are seeing, and this is a global trend, which you can see in India as well, capital expenditure by corporates and governments across the world, including in India, is picking up, especially in India. And we are finding that order books for most of these capital goods companies, some of them you named, are their likelihood to continue to grow at 20% plus is pretty high, actually, probability. Yes, valuations are high. So the way we are playing is we are choosing to go slightly down the curve. So you mentioned of large cap capital goods companies. We are looking at some select mid cap capital goods companies as well in the small cap space. Actually, you find a lot of opportunities in the small cap space in segments in manufacturing space. There are multinational companies as well as Indian companies which are pretty strong in their respective segments, where visibility of growth is high, and ROC, return on capital employed, ROE, all of those ratios are good, and valuations are attractive. So we are playing a combination of growth with reasonable valuations, and I think there is enough opportunity for everybody to do well.
My last question, if we talk of the last, say, a quarter or so, which parts of the market, which areas are you finding appealing, ideas even to add from current levels in terms of earnings quality, valuations, and the relative visibility in the space?
Sure. So I would say I will start with a theme, which is manufacturing as a theme. I think lots of opportunities available in that theme. Manufacturing is a wide theme. There are lots of sub-segments of that theme. And keeping that in mind, I would say manufacturing is something that we are playing in a very big way. Apart from that, banks, as I said, private banks look attractive to us. There is room for valuation re-rating there as well. So that's something that we are playing in a bigger way. Then there is auto ancillary, where both mid cap and small cap, we are playing in the auto ancillary space as well. Apart from that, there is chemicals, specialty chemical, pharmaceuticals, select pharmaceuticals, and telecom. So these are certain segments where, and lastly, logistics. So these are certain select segments where we think opportunity is strong, and that's where we are positive over the long term.
All right, we'll let you go on that one. Thanks so much for joining us on the show today. That was Chandraprakash Padiyar of Tata Mutual Fund talking to us about market and investing and areas which he is hunting for opportunities.